You try as hard as you want, put your ATM code into a brick wall, money doesn't come out, right?
Welcome to the Heart of Wealth, your weekly pulse check on the wealth industry. I'm Dylan Lobo, your host for this week. Today on the show, a warning on private credit trust breakdown, Gen Z wants to be in the office, and portfolio resilience. To unpack all of this, I'm joined by two Citywire journalists, Selin, Bucak and McRae, along with PortfolioMetrix CEO Alex Funk. Hi everyone, thanks for being here. Let's get cracking with our first story, which is about the regulator, the UK regulator, the FCA, saying that the withdrawals from private credit is a result of, it shows a breakdown in trust between investors and private credit firms, and the sector is not the most transparent. Mm-hmm. Selin, you live, you breathe, you eat private assets for breakfast.
I have to now to catch up with the US Times.
So what do you think about what the FCA said earlier this week?
I mean, she's right. Of course she's right. But the funny thing is, the reason that we have so much concern is also because there is a lot more disclosure in the US. There is a lot more transparency because these funds, they file quarterly, they file when something changes, which we don't get in Europe and the UK. But she's right, of course, there is a breakdown in trust. I think investors are not trusting the valuations, where the marks are on a lot of the assets on these portfolios. And the funny thing is now the managers of those funds are slowly saying, oh, maybe the marks are wrong and maybe there is something. So it's just a lot of back and forth, and lack of transparency has been the biggest issue in private markets for a long time.
I'd say the most interesting thing out of that article was very much around don't build a product around what you think it is just because it sells. Right?
Yeah.
And so that angle is quite important when we start thinking about like the retail investor. And the question that I have is it required? Like, do we need this complexity premium? Ultimately, we've got an array of liquid assets that we can build portfolios that are resilient, which we'll get onto a little bit later, in order to get to these outcomes. So when we're creating complexity, someone must absorb that. Yeah. Right? So if the investor is absorbing that, you're giving them an exit door, and the underlying assets, unfortunately, don't meet the profile of what their liquidity requirements are. No one worries about liquidity until they need their money. And I think that's what we're seeing at this point.
So in the same breath, though, the FCA said that despite all of these concerns, there've been significant improvements in private credit, private assets, and the future's never looked brighter, which seems a little bit of a contradiction, a little bit confusing. What do you think, Selin?
Yeah, definitely. But she's right. There have been a lot of improvements because this market has started going after individual investors, right? Retail clients. So they had to open up. You have Blackstone, Apollo releasing yearly holiday videos, doing cheesy things, and like advertising on TV as well. So there's a lot of opening up, but there's still a long way to go, I think, before they get to a standard that's acceptable.
We've seen this movie before, right? So I think if we think about property funds in the UK not too long ago, where we put illiquid big properties in liquid vehicles.
And they all shut.
They all shut. You try as hard as you want, put your ATM code into a brick wall, money doesn't come out, right? And I think that challenge is going to be really difficult when we try and add this, asset class into retail investors' portfolios. And it really brings back the question, is it required? Sure. I mean, the most interesting statement I've heard around this, Dylan, was, when we had Liberation Day, when we've had the wobbles in markets, that's typically when liquidity is tested. And if we look at the share prices of like KKR, as an example, you can see they absolutely tumble across the market because it's liquid, it's traded. And the statement that I heard was, nobody in private assets can hear you screaming, because ultimately the valuation points stay consistent, right? Because it's only updated quarterly or half yearly and so on. But the share price of the provider comes off, and that disconnect is where the liquidity mismatch happens.
Right. It sounds to me, Alex, that a holiday video from Blackstone is not going to convince you to...
Not today.
Not today, not today. Shall we move on to our second story? This is about Gen Z staff wanting to be in the office more, like up to 5 days a week. Jack, you wrote this story.
Yes.
Tell us a bit more.
Yes, so this is part of our pay reports, which we producing about 5 stories on. It's a survey of over 200 employees at wealth management firms. And this most recent story is about working from home, and there's a clear picture that young people are in the office more than ever, whether it's due to wanting to be around senior leadership and kind of sponge knowledge off these senior leaders who've got tons of experience, or whether it's just not feasible to work from home. I mean, I live in a house share. I know many people living in kind of Clapham, Bethnal Green, living with 5-6 people, working in tiny rooms. It's just not possible. So the clear picture is that young people are pushing back into the office, and it's those kind of in the middle of their career who are almost looking more and turning down roles that don't have a degree of flexibility and hybrid working.
Right. So as far as you're concerned, Jackie, you want to be in the office 5 days a week?
I like being in the office. I'm from a generation that, you know, I was at university taking lectures on Zoom,
right?
Seminars on Teams. You know, it's so much better being in the office around people, bouncing ideas off each other. And you know, this is from a journalist perspective as well, getting out, meeting people. And I'm sure it's the same kind of within wealth management. You want to be around people. You want to know what everyone's up to and learn from others.
How do you manage that at PortfolioMetrix, Alex?
It's spot on, Dylan. I think it's an economic reality, not the desire to work in pajamas, right? I think is what we're sort of looking at here. For me, the question goes around presence with purpose. Okay, so when you're in the office, what is the plan and why are we in the office together? What are we trying to achieve that we're not able to achieve on a Teams call or a Zoom call? And if that's not clear, and if the answer is the same that we were going to do at home, that's a failure in the plan, not the policy. Right? So when I'm starting to think about how do we get these different teams together, it's the conversations that we're having around, you know, the water cooler at a coffee break. It's the 20-minute update on the way to the meeting. It's the strategy session that we have with a whiteboard and jotting it all together, allowing everyone's voice to be heard. So I think once you're absolutely clear as to why we want to be together, that's when you have the encouragement, that's when you have the alignment, and that's when people actually do come into the office. And we've seen it more and more. So I think allowing people to plan their life, because again, like we said, there is logistical concerns, there is issues with childcare, we are in this world, we're living it, but there is a happy medium, right? But it can only be led with purpose, not just by accident, not just by policy.
Okay, well, that leads us nicely onto our last story, which is about resilience. But this is about portfolio resilience. So this is a story that one of our journalists, Julian Boville, wrote. He spoke to a multi-asset director at St James's Place, who was talking about building resilience in portfolios against this backdrop of increased geopolitical tension. His opinion was that it's really easy to build resilience because bond yields are 5%. Is it really that simple, Alex?
I mean, factually, arithmetically, it is correct that at 5%, it's far more attractive than at 0.5%. But what you're doing is you're implying that the environment either stays consistent or improves from here. So it is only resilient if yields continue to move down or only up within a buffer. What happens to the portfolio if yields are 5.5 or 6? And so when I think about resilience within a portfolio context, I think about this concept of a portfolio of ideas rather than a single portfolio idea. So if I have 8 or 10 positions and every one of those positions are affected by the oil price, I have perceived diversification. I don't have actual diversification. But if each of those positions are being driven by different factors, interest rates, oil price, GDP, earnings results, I'm now building resilience. I think the article talks also about TIPS as an example, so Treasury inflated, Treasury inflation protected securities ultimately. Now, is that a good investment? Yes, I can make a good investment case for that. But what it also implies is a treble forecast, right? It says you think that inflation is going to be higher than the market thinks it's going to be today. You think real yields are not going to move against you, and you think that the dollar will remain supportive. Now, those are three things layered on top of each other, which can be quite difficult to get correct. So if you're starting your portfolio construction with a macro forecast, I think fragility is there on day one. So when I think about resilience, I think about sources of diversification.
Is that where private markets might come into play as well? If you allocate a bit, it brings a diversified kind of source?
It only brings diversification because of valuation points, right? The real valuation is still what the market reflects. And so it's a little bit of, if I could be a bit cheeky, it's a bit of volatility laundering in some instance, right? Where that valuation must come true at some point in time. It might just be smoothed out. So the reality is still you own that asset and you might need to redeem and you might not be able to redeem at that price.
This has been a great conversation. I'm afraid that's all we have time for. I think we'll all agree that was the funkiest show yet. A massive thank you to our production team and to our guests Alex Funk, Selin Bucak and Jack McRae. Thank you for watching, and we'll see you next week.